Hello everyone, my name is Christophorus Andriawan. We are currently talking about futures and forwards today in this Analyst Starter Pack series. So what is futures price and what is forward price? So forward price is the delivery price that is agreed over the counter by buyers and sellers of the contract for a time in the futures, which is negotiated today. So for forward price, the delivery price is negotiated between the parties, and the time also it's flexible. Whereas future price is the delivery price in an exchange market for buyers and sellers for the standardized contract for a specific time in the futures, which is settled daily. In futures price, because this is an exchange transaction, so it is standardized and it settles daily. There are two positions that the person can do in futures and forward market, which are long. When you are saying that you are long in futures or forward, that means you buy the contract. And when you say that you are short, it means that you are selling the contract. And this is the differences between forwards and futures. In the market itself, for forward, it is traded in over-the-counter market, and for futures, this is in exchange. And for the contract type, as I said before, the forward contract is very flexible. It is negotiated between parties, whereas futures contract is standardized in the exchange. For delivery dates, for forward generally it's one delivery date, so it's one time of the maturities, and for futures it's a range of dates. You know, like for example, for a maturity dates in next 6 months, it is settled daily, so it's the range of dates. And the settlement of forwards is in the end of the contract, so at maturities, and for futures, it's daily. Usually for forwards contract, the delivery can be made in whichever forward agreement or in cash. However, usually people who trade futures, they close out the trades before the maturity. People who are engaged in forwards contract are exposed to the credit risk because there is no barrier, like no organization, for example, like an exchange, to prevent the counterparty risk. So if one of the party are insolvent, then it will be a trouble for the contract. But for futures, because it is exchange traded, so there is some margin required for the trading. So hedging using futures. Why people hedge? So the reason that people hedge is to minimize the risk from, like, for example, interest rates movement, exchange rates movement, the market movement, and etc. But we need to understand as well, there is some limitation of hedging. For example, maybe the investor itself is already well diversified, so the standard deviation or the risk absorbed by the investor is not as much as the people that are not well diversified, and the potential risk also increase. Like for example, if you are hedging because you're thinking that the market will go down, and instead the markets go up, so you're actually capping your capital gain because you are losing in your contracts. Um, there are two types of hedges. So one is long hedge. So long hedge, it means like you are intended to buy the asset in the futures and you want to lock that price. And short hedge, it means you are intended to sell the asset and you want to lock that price. So this is the step for a long hedge. So you want to pay something in the future. So you want to purchase an asset. So the cost of asset itself is the spot price at time 2. And your gain of your futures is the future price on the time 2 minus the future price on the time 1. So the net amount of money that you need to pay in the futures is basically the future price of the time one minus the basis. So basis is actually the differences between the spot and the futures. And for the short hedge, so the price of the asset that we will receive the money in the future. So you want to sell something is S2, and the gain is basically the opposite of the whole long hedge, and the amount that we need to we will receive in the future is the same, is F1 minus B2. So the future price on the time one, and then the basis on the time two minus the basis on the time two. For the hedge ratio, so hedge ratio, it means like, for example, you're hedging something like some asset, let's say jet fuel, and then there are no jet fuels futures that you need to use different kind of oil. Let's say like you use crude oil or you use like heating oil as the hedge. Then you need to adjust your like your hedge. It's similar like a beta in equities, but it's slightly different. So for example, if there are no adjustment on daily settlement, so you just know like the differences between the time zero to time of maturities, you can use the first formulas of the hedge ratios, which is basically the correlation of the changes in spots and in the futures over the hedging time, multiply by the standard deviation of the changes in spot price over the hedging time, divided by the standard deviation of the futures, change of the futures over the hedging time. But for example, if you have the data that you have the tailing adjustment, like daily percentage changes, the formula change slightly different. So instead of the change over the hedging time, you use correlation, standard deviation of the daily percentage change. So for the number of contract itself, we still follow the same formulas with the hedge ratios. So we have the hedge ratios here. It depends on which hedge ratio you use, either like the non-adjustment or the tailing adjustment. But the multiplier are different. So if you do not have the adjustment on daily settlement, you multiply your hedge ratio with the quantity, so with the unit of the position hedge. Like for example, if you have 42,000 gallons of jet fuel divided by like the size of the contract itself, like maybe 5,000 heating oil or something. But whereas like if you have the daily adjustment, instead of multiplying it by the units, you multiply it by the value of the position. So for example, the value of the position is, let's say before it's 42,000 gallons, or 42,000 gallons multiplied by the spot price. And for the value of the futures as well, it's multiplied by the future price. So it's the value, it's not the size or units. So let's go to the example. So this example is hypothetical. So we just try to calculate this in sense of like real life, but it's just for educational purpose. Let's say a winery desired to purchase 50,000 kilograms of Italian red grapes in 1 month, but a financial advisor say that, oh, we don't have a futures contract for Italian red grapes, but instead we have French white grape futures. So, okay, like we can use it, but what do you need? So this financial advisor is actually calculating the standard deviation of change in price of the red grapes over the hedging period. And he said that, oh, the standard deviation is 0.0253 for the red grapes, and for the white grapes, it's 0.0302. And then he plot the correlation graph and calculate the correlation, and it's actually 0.942. It's quite good because it's quite big correlation. The size of the white grape contract is 3,000 kilograms. So if you want to buy these contracts, one contract is equal 3,000 kilograms. How many optimal numbers of contract required to hedge? You can pause this video to try to calculate, and we can go back in 3 minutes. Okay, let's say that you already calculate your calculation. Let's check the answer. So the first thing you need to do is you need to calculate the hedge ratio, which is 0.942, the correlation multiplied by the standard deviation of the asset. So standard deviation of the red grapes divided by standard deviation of the white grapes, and you get the hedge ratio of 0.7892. After you get the hedge ratio, you can find the optimal numbers of contract, which is you multiply your hedge ratio by the original size of your asset divided by the contract size, and it yields you 13.1533. And we can just say that we are long 13 contracts. Why long the contracts? Because we are expecting to purchase. So the winery are expecting to purchase the grapes, the red grapes, in the next periods. And this is if you have the hedge ratios, but instead of a forward, you have a futures index. So it's an index. You can use a beta of your portfolio instead of the hedge ratio. So for example, if you use this for S&P 500 index, you can use the betas for S&P 500s. Let's say we have this example. An insurance portfolio manager expecting a specific cash flow. So she's expecting a payment in the futures. So what is this contract then? Is it long or short? Okay, you can answer it later on in your answer. So specific cash flow in the futures, and she want to hedge the portfolios of 10 millions with the beta of 1.32. And using the S&P futures, currently hypothetically priced at 9,240. The multiplier of one contract is 250. So how many contracts should the portfolio managers long or short? What is the extra position and the type of the contract that the portfolio manager must take if she decides to reduce the beta to 0.85? How about if she wanted to change the beta to 1.88 instead? So I will give you a couple of minutes to answer. You can pause the video and go back to see the result. Okay, I assume you already answered your questions by yourself. So let's discuss about the result then. So firstly, remember we need to calculate the numbers of contract to hedge the N. So because the beta is 1.32 for the original asset, and the expected cash flow received is $100 million, and it's divided by the current price of the futures S&P 500 multiplied by multipliers. So we got to short 57 contracts. Why short? Because we are expecting payment. What if the portfolio managers want to reduce the beta to 0.85? So what we need to do is we need to subtract our original beta by the targeted beta, which is 0.85. So 1.32 minus 0.85 multiplied by the portfolio expected payment received divided by the future price of the S&P 500 multiplied by the multipliers, which is 250. So according to calculation, we are expecting to short extra to 20 contracts. And how about if we want to increase our beta to 1.88? Is actually the same methods, because it yields negative number. So, and we are long extra 24 contracts for this. The reason is why it's long. It's because if the numbers are getting smaller, we expect short in this occasion because we are shorting in the first chance. But if the number is getting bigger, like the beta is getting bigger, then you are expected to actually add some risk, right? And this is how you value the futures of forward contracts. So we have the current spot price, the futures of forward price today, time maturity, and risk-free rate. So it's the current spot price multiplied by the natural number, power R multiplied by T. So let's do some example about forward and futures valuation. Let's say that the non-dividend stock has a price of $25.21 today. And the 3 months forward price of this stock is 25.83, stated in the market. A 1-year interest rate is 3.22%. Could you explain if there is any arbitrage opportunity in these trades? What is the strategy to gain arbitrage profits from these trades if there is any arbitrage? If the 3 months forward price is 25.30 instead, it's not 25.83, but it's 25.34. What strategy to gain an arbitrage profit? I'll give you a couple of minutes to answer and we can discuss your findings. Okay, I assume that you already calculate your answer, so let's discuss the answer together. So first, you need to find the forward price with your formulas. So it's your current spot price multiplied by the normal numbers, power 3.22%, and it's a 3 months, right? So 3 per 12, so 3 months per 12 months. It yields you 25.4138. So because the price is different, it's not the same with the stated forward price. So hence there is an arbitrage. And you remember that your stated forward price is higher than the calculated price. So it means you can short the forward because the things that you expect the payment. You expect the payment when you short forward. So you expect a payment higher than your valuation because that's the stated price. So you want to lock that price. You can borrow 25.21 from the banks and to buy the stock now to deliver it at the maturity. So you keep the stock because you need to deliver the stock and then somebody will pay that because you are engaged in short forward trades. So the realized profit for these trades will be your forward price, stated forward price minus your calculated forward. So which is every contract you have, it will yield you 0.4162 arbitrage profit. But the second question, if the price is 25.34, the forward price, and it's lower than your calculated forward price, then you can long forward because you're basically purchasing something cheaper in the future. So you're paying something cheaper in the futures by shorting the stock. So you ask your broker to short the stock 25.21 and you invest this proceed, you invest the money in risk-free 33.22% until maturities. And you deliver your payment of 25.34. Because of this, you realize the profit. It will be the differences between your calculated forward price and your stated forward price, which is 0.0738 per contract. Valuing futures and forward contract with income. So sometimes the asset have an income, like for example, dividends or any cash flow that you can get to the like from the asset itself. We need to, because in income it's how to say, it's priced negatively in this calculation. So you need to subtract the income by the current spot price. So the calculation is slightly different. You just have spot price minus your income and multiply by the normal numbers power R multiplied by T. And if it's a yield instead of the income itself, you can put the formulas. So instead of subtracting it in the spot price level, you subtract the risk-free rate by the yield stated in this calculation. Now let's make an example. So let's say there's an asset priced at 400 today and it yields 4.27 income to 6 months in maturities. And currently 1-year interest rates is 2.46%. What is the value of the forward contract? And if the asset has 2.31% yield instead, what is the value of the forward contract? I'll give you a couple of minutes to answer and then we can discuss your answer. Okay, I assume you all already finished with your calculation, so we can discuss about the answer together. So first, you need to find the forward price as usual. So you calculate your spot price minus your income multiplied by the normal numbers, powers 2.46% in half year. So it will be $400.6275. And if we have a yield instead of the income, so the calculation is slightly different. You subtract the risk-free rates instead of the spot price. And then this is just to calculate the currency futures. So for currency futures, it's slightly different because you have like a currency exchange price and also differences between risk-free rates. So let's say in here, RA is risk-free rate for a country A and RB is risk-free rate for country B. So you do the calculation by subtracting the risk-free rate of the country A minus the country B for this calculation, because the equation of the forward and spot price, it is defined here for the currency exchange. So let's try a hypothetical questions here. So let's say we have there is an investment fund analyst in lemon country desire to lock in the current rate lemon per apple in 3 months. The current exchange today display the price of 2.48. The annual risk-free rate of lemon is 4.75% and apple is 2.98%. So what is the future rates in 3 months for lemon and apple exchange rates? I'll give you a couple of minutes to answer and we can discuss your answer. Okay, I assume you already answered your question, so let's discuss it together. So in this calculation, it's very straightforward. So you just put the price multiplied by the normal numbers, power 4.75%, which is the lemon country, minus 2.98%, which is apple country, multiplied by the time. So it's 0.25 years, and it's equal 2.49110. And I'm just gonna give you some formulas as well. If we have futures and forwards contract with cost and carry and convenience yield. So I'm just gonna explain it briefly. So in this calculation, we have a storage cost. So storage cost behaves the same like is the opposite of the dividend. So instead of like subtracting the Risk-free rate is actually plus the risk-free rate, so it's the opportunity cost. So the storage, the cost of carry is basically the risk-free rate plus the storage cost. And we have also convenience yield. So convenience yield, it means it's has a similar, how to say, similar natures like dividends. So it's a subtractions of the risk-free rates. So if it's an investment asset, the forward or future price must be equal to normal formulas. But if it's consumption asset, it can be equal or less because it's consumed. There is some consumption on that. So you can see also the calculation, it will be C minus Y on the calculation. So for the next session, we will discuss about bond pricing. And thank you very much to attend this session online. And I hope that this knowledge is useful for your journey in becoming a financial analyst. Thank you very much.